All right, ladies and gentlemen, it is just a little bit after 3:30. Welcome to a special Thursday edition of OIC's webinar program. I am Mark Benzequin. I am a principal here at OCC, part of the investor education team. Speaking of which, we're very fortunate to have the entire investor education brain trust along with me. I've got my colleagues Ken Keating, Matt Cashman, and Roma Caldwell along with us behind the scenes to answer your questions as they come in. They're going to be handling Q&A throughout today's presentation. They're also going to put a couple of those questions in their pocket for me to address to all of you at the end of today's session. Today we're going to be talking about covered calls. It's going to be a two-part presentation for the month of June. As a matter of fact, the entire summer, we're going to be talking about what we call our summer of selling. So we're going to be talking about all types of premium income generating strategies. We're going to start with the basics today, that being covered calls. And then next week, we're back to our regular Wednesday schedule where we will talk about cash secured puts and then put those together in what people call the wheel strategy. For myself, I've been in the business 25 plus years, been part of the investor education team here at OCC for going on 9 years now. Basically, I'm one of the content creators. I help create the webinar program as well as our online courses that we have in OCC Learning and also the monthly podcast program. So enough about myself. Let's go ahead and take care of our legal requirements. Here's the standard disclaimer that I'm sure you've seen many, many times. Options involve risks and may not be suitable for everyone. There is a booklet that outlines those risks called the Characteristics and Risks of Standardized Options, also known as the Options Disclosure Document or the ODD. You can get a copy of the ODD available for download on our website, optionseducation.org, or contact your brokerage or trading firm for a hard copy. The examples that we're going to be using today, we're going to keep things simple. We're not going to include taxes, commissions, interest rates, anything like that. We just want to look at the nuts and bolts of the trade and the mechanics of how all that works. And then lastly, any strategies that we discuss simply for educational purposes. We are not trying to endorse or provide any recommendations for any specific strategy. Throughout the presentation, you'll see some of the trademarks, both from OCC and OIC. And speaking of OIC, if you're not familiar with us, we are a free and unbiased organization that provides options education. We are the education arm of OCC, the Options Clearing Corporation. We do the majority of our educating through our website, optionseducation.org, where, as I mentioned earlier, we offer a wealth of online courses, podcast videos, and today's webinar program. Sorry about that. I think I lost some audio for a moment. I was talking about OIC and our investor education team. As I mentioned, we've got the brain trust of Roma, Ken, and Matt behind the scenes to handle your Q&A. Any questions that we don't get to today, that you don't get a direct response on today, we will be reaching out to you tomorrow via email. So all of your questions that you ask, you will get an answer. Also, at the end of today's sessions, there's going to be a survey to let us know what you thought of the topic, what you think of OIC, and what you think of me as a presenter. So we will address each of those comments as well. So make sure you take a look in your inbox, and we will be getting back to you shortly. Well, with all that out of the way, let's go ahead and get into it, what it is we're talking about today, covered calls. We're first going to break down the mechanics of covered calls, what they are, why people might use them, different situations or scenarios in which an investor might choose to trade a covered call. Then we'll get into strike selection, the potential impact of dividends. Because we're selling options with a covered call, we're always going to be subject to assignment, and there are certain cases or certain instances where assignment might be more likely than others. And in those situations, how you might manage that position. So that's what we're going to be talking about today, and we're going to close everything out with some Q&A. So let's go ahead and get started. Covered call mechanics, what are they? Well, a covered call is a strategy that combines stock and a short call option. And what I mean by that, typically you'll have 100 shares of stock. Against that, you would sell a call option, the strike price of which would be your own choosing. But it is a combination of long stock, typically 100 shares, and a short call. So one covered call or one short call paired with each 100 shares of stock. In terms of a motivation, covered calls are typically for a moderately bullish or even a neutral investor. The reason we say that, we're selling options. So when we sell options, that premium that we collect from the sale is typically going to be our maximum return. And the way that we generally realize that return is for that option to expire out of the money, which is something that we'll get into in a little bit. But the idea is that contract expires out of the money, and the investor retains all of that premium as profit. And the reason I say neutral is because the market really doesn't need to move anywhere in order for this covered call investor to realize a profit. I also say moderately bullish. The reason being is because we're selling that option. The strike price is going to determine the exit price at which our shares are called away. So if we're really bullish on a security, we think that there's a lot of running room for that stock price, a covered call might not be the best strategy for the investor. The reason being is because they are always at risk of getting those shares called away. But in terms of a primary goal, remember I had mentioned that the investor doesn't really need for the stock to go anywhere. But if you are just a stockholder, you've got 100 shares of stock XYZ, and let's say 60 days out, the share price is still at the point at which we had purchased, well, we're not going to make any money on that stock. If we buy stock, we need that stock price to go up in order for us to be profitable. The covered call adds a different wrinkle or a facet to that stock purchase, in that we really don't need that stock to go anywhere because the sale of that covered call is going to boost our returns. And again, that's something that we'll explore in just a little bit. It also helps reduce the break-even point. If we bought 100 shares of stock at, say, $75 a share, then that's our break-even point. Stock needs to be above $75 a share in order for us to make any money. If it falls below $75, we lose money. But if we sell a covered call for, say, $2, now our break-even point is reduced down to 73. So even if the stock stays at 75, we're still going to profit on this trade from that sale of the option. So it reduces our break-even point. However, it doesn't do much to reduce our overall risk. Remember, we've got a long stock position, and theoretically, stock can drop down to near zero. What the covered call will do, and again, this is something we'll get into in a little bit, but what the covered call does is that the premium that we receive provides a little bit of a cushion, but really that primary risk is going to remain with that stock price. Some investors might sell covered calls regularly, meaning every week or every month. There are certain strategies out there where you'll be selling covered calls repeatedly, on a weekly basis or something like that. And again, the idea is if your trade expires out of the money and you retain all of that premium, you still have that stock position, so your stock didn't get called away. And now you can simply sell another covered call against it, sell another short call against that long stock. You might do it on a weekly basis or every month or what have you. But the idea is that you can do this strategy time and time again on a repeated basis. Now, that strike price, that can be tailored according to your forecast, according to your objectives. In this case, the objective is to retain that premium that you collected when you sold that option. You could also tailor the days to expiration, or DTE as everybody calls it now. Those can all be tailored to an investor's risk and forecast tolerance. We're going to be getting into that in a little bit with strike selection. Like a lot of things, the choice of strike and expiration is going to be a balance between risk and reward, just like pretty much any other strategy. But that strike selection, to me, is very important because that's the price at which our shares can be called away. And as we're selling options, we are always at risk of assignment. The assignment would be the process where our shares get debited out of our account and we get credited with that strike price. So basically, we're selling our stock. If we've got American-style options, that can happen at any time. Assignment can occur at any time. Now, typically, assignment only occurs at expiration. Not always the case, but that's typical. But something else that I want to address is that a lot of people see assignment as a negative thing or a worrisome event when it comes to trading covered calls. But it really shouldn't be, because what assignment, at least for me, what assignment tells me is that my objective was met. If I bought stock at, let's say, $100, there's got to be a price at which I'm willing to sell those shares. So the question is, am I willing to sell those shares at 105? Am I willing to sell that stock at 110? Whatever price I'm willing to sell those shares at, typically that's going to be the strike price that I choose. So if I get assigned, it's telling me that my forecast was correct or my objective was met, that I was willing to sell those shares at $105. The stock moved up. It hit that point at which I was happy to sell, and I did. I sold my stock at 105. But to sweeten the deal even more, I also collected the premium when I sold that option. And if that premium was $2, for example, now I'm not really selling my stock at $105. I'm selling my stock at $107. So not only did I hit the exit point that I was looking for, but I also got a little bonus premium on top of it. So assignment, not always a bad thing, but it is always a possibility when it comes to selling options, whether it's selling calls or selling puts, whether we're talking about a credit spread or an iron condor or what have you. Any strategy that involves short options, that option writer is always at risk of assignment. Now, some of the other aspects of covered calls, we've got a limited upside profit potential. Again, that strike price is going to limit how high we are going to participate in that share price appreciation. So our upside profit potential, what we might call our maximum profit, you can see here it's going to be our strike price minus the price at which we paid for the stock initially, plus the call premium we received. So all of that together, that's going to be our maximum profit on the trade, because if we get assigned, remember, our stock is going to be sold at that strike price. At expiration, our break even is going to be the price that we paid for those shares minus the premium we received. But here's the really big thing that I try to point out to people. When it comes to covered calls, most people are concerned about assignment, which, as I just mentioned, may not be much of a concern to begin with. But what they don't realize is that their main risk, again, lies in that long stock position. The stock can drop to near zero. While the premium that we receive will provide some cushion, will provide some protection, we do have pretty much all of that risk left in that long stock. Depending on that strike price, that is going to determine the amount of downside protection that we have. And we'll get into a little bit as to trading in the money calls versus at the money and out of the money. But regardless of where that strike price is that we choose, we still will have all of that downside risk from that strike price minus the call premium we receive, and that's going to be our total risk. And let's go ahead and look at an example to see how that might work. Here we've got a hypothetical situation. Our stock is trading for $100. We're long 100 shares of our favorite XYZ, trading $100 a share. We are maybe moderately bullish. We think there's going to be some running room to the upside for the stock. We choose to sell a $105 strike call, so we're looking for maybe a 5% increase in the share price. And when we look at our options chain on our favorite trading platform, whatever that may be, we see that the 105 call is trading for a quoted price of about $2.50. And let's assume that this is, say, a 30-day option. So we've got stock trading $100, 105 call is what we sell. We collect $2.50 premium in that. We are neutral to moderately bullish. Our objective is we're looking to generate premium income, and we've got a target sale price just above that current share price, all right? So what does that look like? You can see here the P&L chart at various stock prices without the covered call. And let me get my, here we go. Let's get our laser pointer out so it might be a little easier for people to see. So here we go. Here's our $100 share price. If stock doesn't move at all, well, we haven't made any money. We haven't made any money and we haven't lost any money. So we need, as a shareholder, we need stock to increase in order for us to make any money on the trade. But when we incorporate the short call into it, even if the stock price doesn't move, we're going to make $250 on the trade come expiration. If the stock price does move as we forecast, remember we're moderately bullish on it, and if the stock goes up to, say, 102.50, well, we're going to make $250 on the stock, but we're also going to make $250 on our option. That's what we collected initially, gives us a total profit of $500. Stock goes up to 105. Again, we make $500 on the stock. We have that same $250 on the option, total P&L of $750. But you can see here, as we go higher, as we go above 105, and it doesn't matter if we go to 107.5, if we go to 120, or if we go to 500, our shares are going to be called away at $105. So we're not going to make any more money on that stock because we are no longer going to own that stock. We will assume that the shares are going to get called away at expiration because the share price is above our strike. And what's going to happen is, regardless of where stock goes, we're going to be selling it for 105, and we're going to have a maximum $750 profit on the trade. Stock goes to 110, same thing. Stock goes to 500, same thing. Max P&L on this particular trade here is going to be $750 profit. Now, on the flip side, if things don't work out for us, because, when does a trade not ever work out for a trader, right? If our forecast is wrong, if things go south on us, and rather than increase like we expected the stock to do, but it decreases, well, again, our risk is going to sit with that long stock. So stock can drop down to 97.50, not a problem. Rather than losing $250 on the stock, it's completely offset by the credit that we received when we made the trade initially, and we are flat. So with the option, with the covered call, our break-even point is 97.50. Without the covered call, our break-even point is $100. So again, we lowered that break-even point. But you can see that as the share prices continue to drop, we lose more money on the stock. That is slightly offset by the premium that we collected on our option. But we do lose dollar for dollar minus the premium that we collected. So stock goes to $90, we're going to lose $1,000 on the stock, but that's offset by the $250 we collected when we sold the option for a net loss of $750. And that's going to continue all the way down towards zero. Now, One thing to note, as I mentioned in the disclaimer, all of the examples that we're going to be using, we're not going to be including any transaction costs. So there are no commissions, fees, taxes, anything like that in there. For those of you that might be more graphically inclined, here is what our P&L looks like in chart form. You could see without our option, here's our stock break-even point, $100 on the head. When we introduce our covered call, it reduces our break-even point to 97.5, but it also limits our upside participation. If we just had the stock, we've got an unlimited upside. By introducing the covered call, we are capping any gains above 105. So if share prices go above 105, we are foregoing those gains. So our maximum profit, if we get assigned, remember, it's going to be our net stock sale price, which is going to be our stock purchase price minus the price at which we sell it. And then we're also going to be adding back in that premium that we collect. So our effective stock sale price is going to be the strike price. That's the 105. We add in that premium, so our effective stock sale price is 107.5. We back out the original purchase of 100, and here's our maximum profit per option. All right, makes sense? Seems simple enough? All right. Again, if you have any questions on this, please make use of Matt, Ken, and Roma, who are sitting in the background. Collectively, they've got over 75 years of experience in the business. Covered calls are one of the more basic strategies out there. So if you have any questions, I guarantee you Matt, Ken, and Roma will be able to provide answers. Let's go ahead and get into strike selection and what people might want to look for when it comes to choosing a strike. As I mentioned earlier, it's going to be a balance of risk and reward, just like any other strategy. And the reason being in this case is because the strike price is going to determine where we're able to, not where we're able, I should say, but where we will be obligated to sell our stock should we get assigned. So, for example, if we've got a $100 strike price, we're looking at 30 days to expiration. Here is a sampling of available strikes ranging from $95 to $105 and the corresponding quoted premiums that go along with them. So if we had a $100 stock price, anything below $100, that's going to be in the money. So the $97.5 call, in the money, the $95 call, in the money, the $100 call, that's going to be at the money, and then anything above 100, those are out of the money. And if you've been trading options for a while, or at the very least, if you've been learning about options for a while, you're familiar with the concept of moneyness, but you're also familiar that as you go further away from the strike out of the money, the cheaper that option's going to be. As you go further away from the strike in the money, the more expensive that option's going to be, as we can see. So a $95 call, $6.60 quoted price, that's going to be $5 in the money from where our stock is. If we go $5 out of the money, we've got a $2.50 is the quoted price. So you may look at this on the surface and say, well, then why wouldn't I just sell a $95 call, because this way I get $6.60 premium, which is considerably more than a $2.50 premium. And I would say you're absolutely right. $6.60 is bigger than $2.50. We can agree on that. But then there's more to it, right? When it comes to options, it's never really just on the surface. There's always something below the surface that we need to look at. And when it comes to strike price, what's below the surface is that we need to keep in mind that, sure, if we sold this $95 call for $6.60 premium, that would entail to a maximum profit of $101.60, right? And we bought the stock for $100, so we're really only going to profit, if we got assigned, $1.60 on that contract. And that would come out to a 1.6% 30-day ROI, which is considerably less than if we sold this 105 call for $2.50, we've got an ROI of 7.5%. So again, considerably higher. We've got a much higher maximum profit if we sell out of the money, much higher return on our investment by selling out of the money. But again, there's more to it. If we sold that 105 call, the only way for us to achieve that maximum profit is if stock actually got to $105 or more. If stock didn't go anywhere, let's say stock stayed at $100 over the next 30 days, well, this 105 call would expire worthless, which is wonderful. That's, kind of what we're looking for. We would retain this $2.50 premium. But had we sold the at-the-money $100 call, and again, stock finishing at $100 on expiration, no stock movement, well, we could have collected $4. So that would have been a $400 profit versus a $250 profit. So when you're selling out of the money, in order to achieve that maximum profit, you really need that stock price to move. Which isn't, it's not unheard of. Remember, we're moderately bullish. We think the stock is going to go up anyway. So if our forecast is correct, and if things happen as we expect, it might be possible for us to generate a higher return by selling that out of the money option versus selling an at or an in the money. Another aspect that we would want to look at is this downside protection. If things didn't go the way as we expect, which frankly happens more often than I would like to admit. But if things didn't go as we expect, we only have a $250 cushion to offset the stock loss with this out-of-the-money option versus a $660 cushion with this in-the-money option. So, again, it's kind of, as I mentioned, it's a trade-off. It's a balance between risk and reward. You could say it's a dance between the two. Because you're giving up one to get the other and vice versa. So there's going to be a lot of give and take. Another thing to consider when selling in the money options, even if the stock didn't move, if it stayed at $100, well, our short calls that we sold are in the money, so they are going to get called away. So, or I should say, it's likely that they would get called away. So even if stock didn't move, this $97.50 strike, we would be selling our stock at $97.50 plus the premium that we collected. So even if stock didn't move from $100, we're selling, and this would be our maximum profit, $102.70. So theoretically, we would generate a $2.70 profit if stock didn't move and we sold this in the money call. Again, if stock didn't move or even if stock dropped, we would be making a profit of $1.60 on this $95 call. Not only does so the strike price, not only does it affect your maximum profit, returns, downside protections, et cetera, but it also pertains to your forecast or your outlook for the stock, whether you're a defensive covered call seller, if you're speculative, or if you're market neutral. If you're defensive, then you might look to sell an in-the-money call. The reason being is because it provides the greatest amount of that downside cushion should things not go the way that we're expecting. So should share prices fall, remember our risk is in that long stock. By selling an in-the-money call, they give us a higher degree of protection simply because it's got a higher amount of premium. However, it also gives us the greatest likelihood and probability of getting assigned because those calls are already in the money. If we're looking to speculate, we would look for an out of the money. When you speculate something, you are certainly when it comes to stock, we define speculation as being, for example, extremely bullish. So you think the stock is really going to be making some moves. You certainly don't think it's going to be staying where it is, and you certainly don't think it's going to be going down. You're putting your money behind the idea that the stock price is going to increase. So by selling a covered call, you are incorporating the greatest amount, or a speculative covered call, I should say, with an out-of-the-money strike you are giving yourself the widest amount of upside participation from where the current stock price is up to your short strike. But unfortunately, again, there are trade-offs. The trade-off here is that out-of-the-money contract generates the lowest amount of premium income. What that also means is that hand in hand with the premium income is the amount of protection that it gives us should things go wrong. So it does give us the greatest amount of maximum potential profit because of that wide or wider range from where shares are currently trading to where we're willing to sell them. But it also provides us the least amount of protection should things go wrong. Market neutral, maybe this is the Goldilocks. Bed too hard, bed too soft, maybe market neutral is right. Selling an at-the-money call, covered call, that's going to be more market neutral. We're not really expecting a lot of movement in the market, but we're looking to generate some additional premium income from our stock with the expectation that we're not going to be getting the returns from the stock because it's going to be stagnant. We're looking to get those returns from the sale of the option. The thing about this market neutral thing about selling at the money, it's kind of a balance between premium we receive from selling, a balance of in the money versus out of the money. It also gives us a little bit of a balance in terms of downside protection. But it also, because we're selling it near the current stock price, it also has a higher probability of that short call getting assigned than it does with the speculative position with that out of the money option. So that is strike selection in a nutshell. In terms of expiration, or DTE as everybody likes to call it, for me that's a little bit easier to understand, or I think it's a little bit to understand for all investors. Anytime that you're doing a trade, whether it's a covered call, a condor, you're buying a long call, what have you, you start out with your forecast. Where do you think the stock is going to go? And more importantly, or maybe equally as important, is how long is it going to take to get there? So what is it that you expect to happen, and when will that occur? So the when will that occur, that translates into our DTE. That translates into our expiration date. If we think that the stock is going to experience a 5% rally in share price and we sell a 105 covered call against it, well, when is that 5% rally going to occur? Is it going to occur in the next 30 days, the next 90 days? If we think it's going to happen over, say, the next 45 days, just an arbitrary number out of my head, if we think it's going to happen in 45 days, then it wouldn't make sense to sell a covered call with a 2-week expiration, right, with a 14 or 15-day DTE, because what we expect to happen won't occur by the time our contract expires. So we want to make sure that the option that we sell, or even for that matter, an option that we buy, so this doesn't necessarily just apply to covered calls, but any trading, we want to make sure that our expiration date encompasses the event or the occurrence or the run up or run down in share price that we're expecting. We want to make sure that our expiration date encompasses that time frame. Now, something else to consider when it comes to options, the phrase "time is money," something that certainly we've all heard. When it comes to options, the further we go out in the time horizon, the more premium an option buyer is going to pay, and the more premium an option seller is going to collect. And the reason being is twofold. And this is kind of a back to basics explanation. So for those of you that are familiar with covered calls or more advanced in your options education, allow me to digress for a second. I had mentioned that when you're buying a stock, for example, you need that stock price to increase in order to profit. Translate that into options. Options are kind of the same way. When you're buying an option, you need for something to happen. If you're buying a call, you need that stock price to go up or implied volatility to increase, but that's another animal. If you're buying a put, you want that stock price to decrease or implied volatility to decrease, et cetera. But the idea is that you want something to happen. And the longer time frame you have, the wider time horizon that you have for that something to happen, right? Well, it's going to cost money. From the seller standpoint, I have a much better idea of where shares XYZ are going to close tomorrow versus where they might close 60 days from now or 6 months from now or 2 years from now, right? So the further I go out as a seller, the more uncertainty I have as to my risk. How likely is it that the stock price is going to go from 100 to 105 or, from point A to point B? It's a lot less likely to make a movement over the next 2 days versus the next 2 years. The next 2 years, anything can happen with the stock. So as a seller, I'm accepting a tremendous amount of risk when selling those options. And to compensate me for accepting that risk, I am going to go ahead and charge a higher premium. So when we talk about expiration dates, the further we go out in time, the more premium that option seller is going to be able to receive. With a covered call, right? The further we go out, the more premium we're going to receive, which is kind of the name of the game. But again, the downside is anything can happen within that time. You could sell a covered call 2 weeks out, or you could sell a covered call 2 years out. The probability of something going wrong is, as a seller, is significantly greater over the next 2 years, over the next 2 weeks, hence the larger amount of premium. So again, when choosing that expiration date, make sure that it encompasses the event in which you expect to happen, and then also be cognizant that along with more premium that you collect comes the more risk of anything happening with that stock, and in this case, the possibility of getting assigned. All right, let's go ahead and move on. Dividends. So I mentioned that with an American-style option, and typically American-style options are going to be all of your equities and the majority of your ETFs. So American-style option tells us that the option holder, right, the option buyer can exercise their contract at any time for any reason. A European-style option, for those that don't know, those would typically be our indices. Those are European-style. They can only be exercised on expiration day. But when it comes to a dividend, and put yourself in the stockholder's shoes, if you would. So, here I am, Joe stockholder. I've got 100 shares of XYZ, and a dividend is about to be paid. Because I am a shareholder, I am entitled to that dividend, right? Everybody's happy. Rather than owning those shares, if I own a call option, which gives me the right to become a shareholder through the process of exercise, the only way I can capture that dividend is if I exercise my long call. Now I'm a shareholder. Now the dividend comes and I get it. So I'm happy with that. Now look at it from a covered call perspective. Remember, it's a two-part position. The first part is that you are long stock, so you are a shareholder. You are entitled to that dividend, or likely you are entitled to that dividend. But you also are a writer of a short call, and that obligates you to sell that stock. So if I've got stock that I'm waiting for a dividend to come in, but I'm obligated to sell those shares if I get assigned, then that could be a problem, because not only am I selling my stock, but I'm also giving up my right to that dividend. Now, this typically happens, obviously, when there is a dividend in play. And this was when I had mentioned how typically assignment only occurs on expiration or very, very near expiration, with the exception of the dividend. And this is the reason, because the only way for a long call holder to be able to capture that dividend is if they exercise that contract. So as a option seller, the short call writer of this covered call position, I may be at risk for early exercise if there's a dividend in play. And you can see here it's kind of a rudimentary checklist of things to be on the lookout for in order for you to help determine whether or not you're at risk of early exercise. First and foremost is if the call is in the money, right? If we had an out of the money call, or stock's trading $100 and I'm short a $105 call, it's unlikely that somebody's going to exercise and buy stock from me for $105 when they can simply buy it for $100 in the open market and collect the dividend that way. So if I'm out of the money, it's unlikely that there's going to be a need for exercise early or not. At the money, kind of the same thing. So if the call is in the money, that's one of the check boxes that get marked off to see if there's potential for early exercise. If expiration is near, that's another one. Remember, if I've got a contract that's not expiring for another 6 months, then it likely still has a lot of time value. Now, when you exercise a contract, when a buyer exercises their contract, any time value that's left in that contract, they lose. So if let's say we've got an example, stock is trading $100, I've got a $98 call, right? I'm short a $98 call, so it's $2 in the money. If that call is trading for $2.50, then the option buyer, the holder of that call, can simply turn around and sell that call back to the market for $2.50 and then simply buy the stock outright. So they bought the stock for $100, but they collected $2.50 when they sold their option in order to close out that long call position. And theoretically, they're in the stock for $97.50. If they were to exercise that contract, rather than sell to close and take the money and buy the stock on their own, they would be buying stock for their strike price, or $98 a share. So in that example, in that scenario, it would probably make more sense for the long call holder to simply sell to close rather than exercise. And the same thing goes the further out we go. Now there's even more time value in the contract. The value or the premium on that option position is going to be even greater, and it would, if the call holder were to exercise, they would be leaving more money on the table with a longer dated contract than with a short. So if expiration is far off, unlikely that this short call writer would be subject to early exercise. And then the dividend amount. A lot of people have a kind of a rule of thumb that if the dividend amount exceeds the extrinsic value, that's the time value portion of the option, they may be subject to an early assignment. And that may be true. It depends on the dividend amount, but again, it may be that the investor would do better to simply sell the contract back to close and buy the stock outright themselves. But regardless of any of these scenarios, all of these can be true, or none of them can be true, and you can still be subject to early exercise, because any American-style contract, whether it be a short call, short put, part of a vertical, a credit spread, an iron condor, or what have you, the buyer of an option, the buyer of an American-style option, has the right to exercise at any time for any reason, period. So while these are good indicators as to the likelihood of a potential early assignment, they certainly are no guarantee that it won't happen. And it looks like we've got about 15 minutes left, so let's get into managing the position. This is something that most people are most interested in. So potential position management scenarios, well, you can always get out of it, right? If things are going well for you or things are going bad for you, you can simply close the trade. There's nothing saying that you have to manage the position, and actually closing the trade is a position management technique. Always a consideration whether you want to still be involved in that stock. You could Simply sell, buy that call back to close to close out that short call position. You could unwind the trade entirely, sell the stock, buy back the call, and move on to something else. So getting out is always an option, pardon the pun. Accepting assignment, again, because assignment is inherent to the strategy, there are many investors that welcome it. They're at risk of assignment. Okay, great, not a problem. Because remember, earlier in the presentation today, we talked about that when you get assigned, it means that your objective was met, your forecast was met. What you thought was going to happen or what you were hoping to happen actually did. So it certainly can be a win-win situation, whether there's a dividend involved or not. But a win-win scenario, you were expecting it to happen, it did, and you're moving on to your next trade. Now, something else that a lot of people do is rolling the position. Rolling is simply just closing out your existing position and opening a new one. You can roll up to a higher strike, you can roll down to a lower strike, or you can roll out for more time, or you can do a combination, up and out, down and out, what have you. But you're closing out your existing position, you're opening up a new one, and all that's going to do is it's going to adjust your break-even point, because now you're basically in a whole new trade, right? Now you've got a new strike, now you've got a new expiration date, possibly. You paid or received additional premium to get to get out of the initial trade and into the new one. Maybe you're buying or selling more time. But the idea is it's going to be a completely different trade. So you're going to have a new profit and loss statement, you're going to have new max risk, you're going to have new max loss, et cetera. One thing that investors typically do is they avoid selling their stock. Let's say you're long stock and it tanks, it drops down 20%, you want to get out of it. Your short call is likely going to expire without value. Certainly if you were trading it at the money or out of the money short call, it's going to expire without value. You don't want the stock because, maybe there were bad earnings, or, you don't agree with how management's been running the company, what have you. You want to get out of it. What investors typically would do is they would avoid just selling the stock and leaving that short call, because it's going to require a large margin from your broker. What would typically happen is they would buy that call back to close for pennies. Certainly if there wasn't a lot of value left in it, buy that call back to close for pennies, sell their stock, and move on. And let's look at a few different scenarios here. Here's a covered call position that we're putting on. XYZ stock, our favorite, is trading $59 a share. We're moderately bullish. We think there's going to be some price movement, but not a lot. And we're looking for more than, just a dollar or two. If the stock goes up to 60, we're only going to make $1 on it. We're looking for something more. So we see that the March $60 call is trading for $4. That's going to lower our break-even point down to 55 from 59. Okay. Again, which is something that we like. It lowers the point at which we begin to make or lose money. We've got about 6 weeks to go until expiration, moderately bullish. Here's our position, break-even point 55. With time to go in the position, stock is now, the March option, it went from $4 down to $1. Right, so we've got an unrealized loss of $1 from where the stock was to where our break-even point is and where that option is currently worth. Now, if we're moderately bullish, if we think stock is going to turn around and come back, maybe we hold on to our position. If come March, our stock expires under $60, the option that we sold is going to be worthless. And so all of this $4 we keep in our pocket. We bought stock for $59. We keep this $4, so effectively we're long stock at $55, regardless of where shares end up. This is our new cost basis, you might say. So that's one scenario. Another scenario, we're maybe a little bit more cautious. We're concerned that things aren't going to work out as well as we would hope. Rather than stock staying at roughly $60, now it's dropped. It's below our break-even point. Now, instead of neutral to moderately bullish, now we're bearish. Stock prices continue to decline. Our losses keep mounting. Well, what do? We may choose to buy to close, and actually, I apologize, this should be buy to close the March $60 call, because this is the one that we're short. So we sell that March $60, we buy that March $60 call to close. And, here's what we've got. 6 weeks in until expiration, we're still defensive. The price has stabilized a little bit. We want some more call premium. We decide to roll down that call. Stock has fallen a little bit. We want to boost our returns by selling additional options. So we're going to go ahead and roll down our call, and here's what it would look like. Here's our initial position. Our $60 strike price is right here. Here's our break-even point of $55. The next strike down would be that March $55 call, and that's trading for $3. So we buy to close our initial position, that March $60 call. It's now trading for $1. We're buying that back to close. We're selling the new $55 call by rolling down our strike $5. We collect $3 on that. So now we've got a net credit of $2, and here's our new position. All right, we lowered our break-even point from 55 down to 53. But we also reduced our maximum profit. Now, rather than a max profit of 500, we reduced that down to 200. So max profit potential is lower, but we're going to begin making some of that profit sooner than had we stuck with the original $60 covered call. So it's going to be a higher probability of success for us in terms of profit by rolling that strike down. Now, what would the flip side be? If we're at risk of selling this option at our $60 strike price, but now the stock price has got some legs on it, and now instead of being moderately bullish, now we're very bullish, well, we may choose to roll up the call rather than roll down, right? Stock price has gone from, say, $59 up to $64. The price of the call that we sold increased from $4 now to $5.25, and now we're at a greater risk of assignment because stock is trading 64 and we're short the $60 call. So we might choose to roll up. Again, here's our original position. Here is what it costs to buy back our short contract, $5.25. We can sell the March $65 call for $2.25. So it's going to it's going to cost us money to roll up this position, which makes sense. We were short. We expected the market to go up a little. It ended up going up a lot. So naturally, it's going to cost us money. But by doing so, granted, it increases our break-even point, so now stock has to go even higher for us to make money, but it also increased our maximum profit. Before, we can only make $5. Now we can make $7. So we're looking to make more money on the trade, and by rolling up, that is a way to do it. All right, that's going to do it for us today. Let's go ahead and just go over some of the key takeaways that we had talked about, things that we learned during today's session, hopefully that we learned. Covered call strategy, 1 part long stock paired with 1 part short call. So it's going to be 1 short call for every 100 shares of stock typically. In terms of a forecast and a motivation, forecast would be neutral to moderately bullish. Remember, if we're aggressively bullish, this likely isn't the strategy because we will have a point at which we're going to have to sell those shares whether we like it or not. So if we're aggressively bullish, probably not the right strategy for you. In terms of objective, there's certainly a couple of objectives out there, that downside protection is one, but let's face it, the reason people sell covered calls, I would, say 98% of the time, and again, just a number off the top of my head, please don't hold me to it. I would say that the bulk of the time people are selling covered calls is they're doing it to generate that income that they derive from selling premium. And remember, when we're talking about income, we're not talking about a regular paycheck. We're simply talking about the one-time payment that you receive from that option until it expires or until you manage the position. And certainly there are plenty of investors, I'm sure, a number of you that are listening today that do pretty well in terms of a steady stream of income generation from premium by selling covered calls or selling cash secured puts. Again, a topic that we'll get into next week. If the strategy involves a short call, again, that strike price, that is going to be the exit price, or that's going to be the price at which we are obligated to deliver our shares, again, whether we like it or not, if we get assigned. So that strike price is going to determine where those shares get sold. So make sure you choose your strike price appropriately. Share price appreciation, that is going to be limited by that short strike again. So depending on where we choose that's going to determine not only the premium we receive, also the downside protection we have, but also the price at which we're selling our shares. And then when it comes to dividends, that may have the potential to cause an early exercise. There are a few road signs, I guess, for lack of a better word, that you can keep an eye on as to whether or not you are at risk of early assignment. Again, whether or not the option is in the money, whether or not it's near expiration, and comparing the time value left in the contract versus the cost of, the amount of that dividend payment. And then in terms of managing the position, again, pretty much like any other trade, you can roll it up, roll it down, roll it out, or choose to simply close that contract. So that's what we have for you today, folks. Just a little bit more about us. As I mentioned, most of our education is on our website. We're very, very proud of OCC Learning. That's going to be our e-learning destination that we've got. We have a 9-course curriculum that is called OIC Academy. We are putting the finishing touches on it and packaging it up as a single curriculum. There also will be a final exam at the end of that curriculum that you can take to gauge how well you know the material or how well you understood the material as you went through these courses. And then eventually and shortly, we expect to have some kind of program where you can print out a certificate and say, yay, I passed this options course, and pat yourself on the back, because it's a lot of information, and it's not the easiest to understand, and it's a lot of information to consume and time to do it. So it is, in my opinion, an endeavor worthy of a certificate and recognition. So OCC Learning, your destination for self-guided study. And then here's our contact information. Optionseducation.org, again, is our website. Options@theocc.com is our email address for investor education. And again, thank you to Ken, Roma, and Matt for all of your behind-the-scenes work. Our website, optionseducation.org, that's where you can also live chat with us. Live chat typically Monday through Friday on days when the exchange is open from the hours of 8 a.m. to 4 p.m. Central. That's going to be that direct one-on-one interaction. You ask your questions, we answer them. Really,